Artificial intelligence remains one of the most powerful themes driving markets today. But behind the excitement, a new financial trend is emerging that deserves attention. Hello and welcome back. I'm Robert Amato, principal at Compass Wealth Management. A number of recent deals in the AI space highlight what analysts are calling circular arrangements, contracts where capital flows back and forth among the same set of companies, often financed with debt. Consider a few examples. Oracle recently signed a $300 billion five-year contract with OpenAI to provide infrastructure for its expanding data center network. To meet that obligation, Oracle is expected to borrow tens of billions of dollars annually over the next several years. Meanwhile, Nvidia has pledged up to $100 billion in staged investments into OpenAI, effectively funding demand for its own chips and infrastructure. Chipmaker AMD just announced a competing deal that will pay OpenAI for their chip business by issuing them warrants for up to 160 million AMD stock shares. And newer players such as CoreWeave and Nebius are using creative debt financing to secure long-term contracts with larger technology firms. On paper, this creates the appearance of explosive growth. In practice, one company's revenue is another's liability, and much of it is being financed by borrowing against expected future demand that has yet to materialize. For these deals to work over time, three things must happen. AI adoption must expand beyond early pilot projects, companies must scale profitably, and debt must remain manageable. Without all three, the industry risks repeating the same pattern of overextension that marked the dot-com bubble. The issue isn't AI itself, it's execution. Implementing AI doesn't automatically create value. Many organizations report that early deployments have added complexity rather than productivity. Simply saying we use AI is not the same as generating measurable results. At Compass Wealth Management, we track developments like these through our investment roadsides, a framework we use to measure market risk and help ensure portfolios remain properly positioned. The goal isn't to time the markets, but to manage exposure so portfolios can weather downturns while staying aligned with long-term objectives. As part of that process, we utilize low-cost S&P 500 sector ETFs that allow us to reduce exposure to the most growth-heavy areas most vulnerable to debt expansion and valuation risk, while maintaining balance through more durable cash flow-oriented sectors. For more detail on how we manage portfolio risk, see our video, Reducing Equity Risk Without Timing the Market, linked below in the description. The AI build-out may continue for years, but innovation funded through circular deals and mounting debt requires close attention. True value will come not from financial engineering, but from sustainable adoption and real productivity gains. Thank you for tuning in. Hi, I'm Robert Amato, principal of Compass Wealth Management. If you found this video helpful, go ahead and give it a like, subscribe to our channel, and hit the bell icon so you don't miss future updates. If you're curious about how we help our clients get the most out of retirement, click the link in the description below to connect with us. Thank you.